Hey, how are y'all doing today? And I hope your week is off to a great start after a Labor Day holiday. Um, Ours was pretty wet, actually, still kind of wet where we are. It's been raining and stuff. So hopefully, you had a great Labor Day holiday and your week's off to a great start. I want to start by talking with you a little bit about what's going on with the upcoming jobs numbers this week. It's going to be a huge number. It's really going to be the number that's going to either have the Fed, when they meet here on the 18th, either cut a quarter or maybe even a half. Everyone's thinking a quarter right now, but the half could be in play if this number falls way short. So I don't know if you caught my prior videos about the jobs numbers that they've been coming out with over the last 12 months. It was the most um, outrageous miss that I think I've ever seen, with overstating the jobs that were created. So, with that said, if you want more information on that, we can talk about it and how that happened and why it's causing such a big problem with the Fed right now because of inconsistent data. So, what I'm going to talk with you about this week is, we have the JOLTS report today coming out actually, and it's a new report that the Fed is using to use as extra data to determine what they want to do with interest rates. Now, keep in mind, when people think the Fed's cutting interest rates, they're thinking they're cutting mortgage rates, that if they cut a quarter, mortgage rates go down a quarter. That really doesn't happen. Mortgage interest rates vary about a quarter of a point on a daily, weekly basis anyway, based on buying and selling in the MBS marketplaces. So it's really about buy and sell. What's supply and demand? That's what's really moving interest rates in a day-to-day basis. But in a big picture, it's really inflation, and it's whether we're moving into a recessionary period, which after a rate hike, almost 100% of the time, we've kind of come down into a recession period. Recession is not always bad, depending on how far it goes. So we expect that to happen. We expect to kind of, as they start increasing rates, for that to happen. But let's keep an eye on the short term here, because everyone's been calling me, my clients and people, about wanting to refinance and wanting to check out what rates were. Yes, rates are still kind of trending lower. They're probably in the low sixes, in some cases, maybe the high fives at this point, depending on what kind of loan you have, whether you have a conventional VA, jumbo, FHA, whatever that is. We can look at that and we can find out what exactly is your trigger point to make the most sense, because if you're here in Florida, the refinancing costs are pretty expensive. And so we don't want to turn it constantly as rates move lower. So we want to kind of figure out where we are today with the win that you may have. If your rate's higher than 6%, how much higher are you? Does it make sense to refinance today? And maybe even again in a year from now? I expect in a year from now, we should see interest rates really trending a lot lower than they are today. And we'll kind of see them trending as we go along. So my goal for you is to keep you informed on how that works. And if you're an active client of ours, you get a free home bot report that tracks interest rates, that tracks the value of your home on a day-to-day basis. It also tracks the difference of, as you're paying down the loan, you're paying partly principal and interest. So it's tracking all the principal that you're growing over time. So if you are not a client of ours and you don't have access to the report, let me know. There'll actually be a link down below where you can sign up and get that report sent over to you right away. If you have any questions about it, don't hesitate to give me a call, 561-373-0987, 561-373-0987. And I'll have my link tree on there as well, where you can sign up for the report, which is ams.money/CP Linktree. So ams.money/CP Linktree. There'll be a link on this video down below as well. So I'm going to let these guys kind of give you an update of what's happening. If you want to listen to it, you can. If you want to hop off or maybe give me a call, you can do that too. If you want for us to review you and put a trigger in place for you, just give me a call or send us your most recent mortgage statement so we can put it in and make sure it's all up to date in the HomeBot system. And so you get those triggers sent out to you, as well as we have an internal trigger that we can set up at certain points in time where you'll get alerts that your opportunity is in play. So you can DM me, you can message me, whatever you want, call me, email us, and we'll get working on that for you right away. So without any further ado, I'm going to have them talk about what to expect today and kind of going forward for the rest of the week. So here we go.
It's a new month. Happy September, everyone. And that means that we're going to get the jobs report data this week. And the Fed meeting coming on September 18th, their rate cut decision is going to be contingent on the jobs report that we get on Friday. Jobs, it's all about you. Market a little bit lower. Mortgage-backed securities are rallying. They're up 19 basis points. And historically, September has been a tough month for the stock market. We'll see if that is a trend that holds true this month, and maybe we see some of the money coming into the safe haven of the bond market. But boy, hard to believe it's already jobs week. And some of the data is pushed to some different days than normal because we did have the Labor Day holiday. So I hope you guys enjoyed a little bit of a long weekend. But it's going to be starting with the JOLTS, or job openings data, tomorrow morning. Now, when you look at the market estimates, they're expecting it to fall slightly to 8.1 million. Now, this is a volatile report. We know that it's likely overstated because of some of the double counting that occurs because of work from anywhere and having the same job opening posted and listed in different states for the same job. But the market has been reacting to this report, and clearly it has been trending significantly lower this year. And when we look at some maybe clues that we can get, there is a company out there, they released this Lightcast data. And what they do every single week is try to look at all the job posting sites and see how many job openings there are. And historically, it has been a pretty accurate tell as to what happens in the actual job openings report. And they are showing a pretty steep decline in July and even a steeper decline in the beginning of August. So this report that we're going to be getting for JOLTS is going to be for July. And if the Lightcast data is accurate, you could see some lower job openings, which the bond market should like. That's another thing that may play into the Fed's decision. And some other data points within the report that I'll be watching very closely is the quits rate and the hiring rate, because those have fallen to some very low levels. The quits rate has been showing weakness because it fell to 2.1%. When you remove COVID, that's the lowest level since 2018. And it shows you less poaching or competition of other businesses trying to steal employees from other companies. And the hiring rate fell to 3.4%. That's the lowest since 2013 when removing COVID, and not far from the COVID low at 3.1%. So some internal weakness that we've been seeing within that report that we should keep an eye on. But it's all going to be about, Diana, the jobs report data that we're going to be getting. Tell us what we can expect there.
Yeah, on Thursday, we'll get the ADP report. The market's expecting 145,000 job creations. And on Friday, BLS, 165,000. And for the unemployment rate to go down to 4.2% from 4.3%.
Yeah, Di, that's what the Fed's going to be looking at. We know that inflation data has certainly given them a lot more confidence that we're going to be heading to their goal. And as we've been saying for over a year, it's all about what happens with the job market, that part of their dual mandate of maximum employment, and that was going to cause the Fed to cut. We had that golden ticket above 4.2% or 4.2% or higher, I should say. And here we are at 4.3%. Now, we know the Fed is going to cut rates on September 18th, but everybody's questioning, are they going to go 25? Are they going to go 50? And of course, they're also going to be contemplating the negative 818,000 in job revision data from the BLS that we found out not too long ago. But I think the unemployment rate and really the strength of that jobs report on Friday is going to be the key. If we see the unemployment rate either remain at 4.3 or possibly increase to maybe 4.4%, boy, that's going to increase the odds of the Fed doing 50 basis points. If it comes down a little like the market's expecting, that'll probably increase the odds of the Fed going 25 basis points. But either way, Fed's going to be cutting rates on September 18th, and this is going to be the beginning of a rate cut cycle. So while the market will make a big deal about 25 or 50, I think the really important thing here is that they're going to begin a cutting cycle.
And before we take a look at the charts with a new month, we'll have a new MBS Highway Housing Index. The survey is now open for you to take, and it's so important for you to take this survey. It gives us a really good idea if you're seeing stronger demand due to rates coming down of late, and if you're seeing a turning point out there in demand. So make sure you're taking that survey, and we'll share the graphic with you next week.
Thanks, Di. Let's take a look at the charts. And listen, the charts are always important to look at. They give us some kind of guardrails on where mortgage-backed security and treasury yields can go. However, the jobs report data is really going to trump technical analysis. But let's just take a quick look here at the charts. Mortgage bonds, they did break beneath the rising trend line that we have seen really since early July. However, they're getting back above the 100.79 technical level, which is an important level. Going back to last year, this was kind of a level it was hard to get past. So we are trying to just break above it now. We have some nearby support at the 25-day moving average. And if we get favorable job data, there is quite a bit of room to the upside before reaching the next ceiling. When we take a look at the 10-year, it's making a nice move lower this morning. It was right around 391 or so. Now it's at 383. And you can see it tested a dual ceiling at the 25-day, as well as the 3.92 Fibonacci ceiling. And you can see how it was rejected and is moving much lower within this range that, boy, it's really been in this range since the beginning of August or so. And it has a little bit of room to go until reaching 380. But hey, if we get some favorable jobs data, love to see it break beneath that. And then look out below. We have room to go down towards 366. And then after that, there's a lot of white space to go down towards about 3.25. So we're going to be watching the jobs data closely, hoping for some bond-friendly news. Hope you guys have a great September, and we're going to begin the week here floating.
Awesome. So that was just a report from Dan. So awesome. So let's see what happens this week. Let's kind of look at some of the reports, kind of what he had mentioned, technical signals. This is what's happening this week here. So this is kind of going to be our determining factor on where interest rates are going to head down in the near future. As he did mention, jobs were almost off by 1 million jobs for the year, March to March, which is kind of crazy. But anyway, listen, I hope you have a great day, and I will catch up with you all soon.